Warren Buffett is widely considered the most successful investor of all time. Currently, he has a fortune of $93 billion, which is quite astonishing considering he was not born into wealth. As a young boy, he started working by delivering newspapers and later selling Coca-Cola cans. In this video, Warren Buffett shares his 3 simple rules for beginners to start investing in stocks successfully. Additionally, he explains how to avoid making mistakes that could ruin your investments. Furthermore, Warren Buffett poses a personal question that you should answer before making your first stock purchase. Have fun watching the video. Warren Buffett started investing when he was only 11 years old. Before that, he says he spent his time doing nothing much of value. At the age of 7, 8, and 9, he admits he was just trifling along. He bought his first stock when he was 11 years old, and he experimented with a variety of things like timing stocks, analyzing stock charts, and other crazy stuff. He had a lot of fun, but he was unsuccessful. He continued with these experiments until he was 19, and he read all the books about investing that he could find in the public library. He devoured them and found the subject fascinating, but he had no solid rules or plans on how to invest. He hoped that making small changes to his chart would tell him where the stock was heading, which was absurd, but he did it anyway. However, he later realized that even if he turned the stock chart upside down, it would not help him. In 1949, when he was 19, everything changed when he read the book, The Intelligent Investor, by Benjamin Graham. Until then, he had never heard of him. There are only 2 chapters in this book that were the key to his success. These 2 chapters laid the foundation for everything that followed for him when it came to investing. In these 2 chapters, there are 3 fundamental rules that are so basic and straightforward that it's hard to believe they are so important. The first rule is that a stock is a part of a company. You cannot think of a stock in any other way. You evaluate a company, then divide the company's value by the number of outstanding shares, and you get the price of 1 share. You have to think about what kind of company you are investing in, what the economic situation is, what the competition is, and how the management is handling the company. All of these things have to do with the company, not a ticker symbol. When he was 11 or 12, every ticker symbol from any company listed on the New York Stock Exchange was the same to him. The problem was that he didn't know anything about the companies. He knew that the ticker symbol was the abbreviation for the company, such as US Deal and T, but he didn't know anything beyond that. Therefore, he had to train himself to think of these abbreviations and names in the newspaper as companies. He had to learn how to evaluate a company and what really mattered when buying a stock. The second rule is a fantastic guide on how to react to fluctuations in the stock market as an investor. In Chapter 8, Graham talks about his mythical Mr. Market, and nothing better has been written about how an investor should behave during fluctuations in stock prices to this day. Most people react incorrectly to changes in stock prices. They feel good when prices go up and bad when they go down. They believe that the stock market is there to guide them, and Mr. Market is there to give them hints. However, Mr. Market is really a crazy person who comes to you every day and tells you the price he wants for his stocks. You don't have to listen to him. But the third rule that Buffett mentions in the video is to have a margin of safety when investing in stocks. This means that you should only invest in companies that are undervalued, so that even if things go wrong, you have a cushion to fall back on. To determine if a company is undervalued, you need to look at its financial statements and compare its current price to its intrinsic value. If the current price is lower than the intrinsic value, the company may be undervalued. Buffett also stresses the importance of avoiding common mistakes that can ruin an investor. One of the biggest mistakes is to follow the herd mentality and invest in popular stocks without doing your own research. This can lead to investing in overpriced stocks and missing out on undervalued stocks. Another mistake is to be too emotional about your investments and panic when the market drops. This can lead to selling stocks at a loss and missing out on future gains. Buffett's personal question that he asks in the video is, would you be comfortable owning this stock if the market closed for 10 years? This question is meant to make investors think about the long-term prospects of a company and not just its short-term performance. If you believe that the company will continue to grow and thrive for the next decade, then it may be a good investment. In conclusion, Warren Buffett is widely regarded as the most successful investor of all time, with a net worth of $93 billion. He started investing at the age of 11 and experimented with different strategies until he discovered Benjamin Graham's book, The Intelligent Investor, at the age of 19. Graham's 3 basic principles of investing: a stock is a share in a company, invest with a margin of safety, and don't follow the herd mentality, have formed the foundation of Buffett's investment philosophy. By following these principles and avoiding common mistakes, investors can start their journey in the stock market with confidence. It is important to remember that investing in stocks comes with risks and there are no guarantees of success. It takes time, patience, and a willingness to learn from your mistakes. However, with the right mindset and approach, anyone can become a successful investor like Warren Buffett.